Good evening and welcome to this second webinar in our webinar series themed Going Global. It's a three-part webinar series where we're focusing on global investing, but more from a structuring and especially around taxes and global estate planning. As people that probably dialed in earlier this month where we had our first webinar, would have picked up that there's a lot of complexities when you start looking at offshore investing. So a key focus tonight is going to be looking at especially the tax part of local and offshore investing. So I've got Anton Maskowitz joining me tonight, and as part of this COVID wave that's hit us, unfortunately, Anton couldn't join me in the studio, so he's joining us from his house in Johannesburg. Anton, it looks like you're well dressed up there and ready for this webinar, so I'm looking forward to this discussion. And maybe just a bit of background on Anton. So Anton's been with Sanlam Private Wealth as a tax and fiduciary specialist for the last 10 years, and he served our clients very well during this period, especially around looking at the offshore structures. And as the taxes keep changing and the laws keep changing, it's something that we've got to continuously deal with in our client base and advising new clients that's looking for guidance on these structures. And I mean, Anton's been, he's got a number of degrees, which I think is a bit long to get through here tonight. But he's got a number of big companies that he's worked for previously. He was with RMB International Advisory Services before. But I think quite importantly, he's also an advocate of the High Court of South Africa, a certified financial planner, a UK trust and estate practitioner, and a member of the Fiduciary Institute of South Africa, and then also a member of the South African Institute of Tax Practitioners. So, Anton, that's quite a mouthful. So we're really looking forward to what you have to discuss with us tonight. But I think maybe as just a brief recap on our first webinar. So we mainly focus on the high-level structuring from people going offshore, and I think the things you need to consider. And I think a theme that we will keep hammering on about is the reason for getting advice. And I know we've got a lot of clients dialing in tonight. We've got a lot of our business partners, financial advisors dialing in tonight. And overall, it's important to go speak to your financial advisor, go speak to your portfolio manager, and get guidance on the structure. So last time we focused on investing in your own personal name, investing through a life wrapper, or investing in via an offshore trust, and just the benefits and complexities of those. So Anton, I think just leading us into this topic for tonight, whenever we speak about offshore investments, and there were quite a couple of questions that came through in our last webinar, people typically start talking about this 1 million rand single discretionary allowance and your 10 million rand foreign investment allowance. And I think there's been some recent changes from the South African Revenue Services, South African Reserve Bank. So there's not always clarity on what that means and how people need to go about applying for those things. Can you maybe just give us a bit more clarity on what they are, and especially around people wanting to take out more than the 10 million as an example? So just some guidance on that side for us to start off with.
Yeah, we can probably hold the whole discussion around that. There's still a lot of uncertainties, but in essence, the foreign investment allowance process and the values have essentially remained the same. The process that we are utilizing now is quite different because they've basically shifted from the old immigration facility, which is no longer available from the 1st of March, so you can't actually immigrate anymore. It's more a focus on the tax resident side. And if you are a South African tax resident, you are now still entitled to take your 1 million discretionary allowance, and that can be used for investment purposes, for donations, for maintenance, and for travel. And there's just a caution on the travel, because I still see a lot of people using the travel facility. And remember, nothing has changed. If you use the 1 million discretionary allowance as a travel facility, you can't actually go and bank that offshore. It has to come back. So you must just make sure that when you do use your 1 million, that 1 million is for investment purposes. That's the election you make for taking that funds or utilizing that facility. The 10 millions are still the same. So if your tax affairs are in order, you can basically get a TCS or a tax clearance certificate with a PIN, and you can take your 10 million offshore. That process hasn't changed. What has changed is, in the old days, we had what we call the special allowance. So for people who wanted to take more than the annual 10 million, they had to go through the Reserve Bank, and there was no process. It was a cumbersome. Nobody knew actually how to apply it, the man of means test. Now it seems to they seem to simplify that. But there's this thing in the tail, obviously, your tax affairs must be in order, one, and you will probably be drawn through an audit process. There will be an enhanced verification process, as I refer to it now. What that will mean, we don't specifically know, but essentially, any person who has got sufficient funds in South Africa can now actually avail of that 10 million plus, subject to a TCS and obviously enhanced facility. So the doors are basically open. You can take out anything you want, subject to your tax affairs being in order and SARS actually having scrutinized you a little bit more.
Okay, so in essence, what you're saying, this reference to 1 in 10 should actually, it's going to probably change, subject to these extra scrutiny and applications you can make to SARS. Okay.
Correct.
And then another question that came through last time, and I think we spoke quite quickly last time around Section 7C loans, and I think there's not always a clear understanding on what a Section C loan is. We often terrible with terminology in this industry, and we throw things around and expect everyone to understand. So maybe there were three core things, and I think that's going to lead us into the main part of this present or this discussion tonight, is around Section 7C loans, this wonderful word called probate and situs. And they're always confusing. So maybe just give us a brief intro on those three things, and then we're going to get, and I'll give us a brief on where we're going to next in the webinar.
Yeah. Just on Section 7C, just the background to that, obviously in the local context, from what you call an estate pegging device. In the old days, it was fantastic. So you could actually loan funds to a local trust on interest-free basis. And then you basically, the loan is still an asset in your estate, but you pegged your estate because the growth element then took place in the hands of the trustees. And that growth element is basically outside the scope of the estate duty net. Then introduced Section 7C because that basically says, if you make an interest-free loan, the loan is still interest-free, but you now have to go and deem an interest rate on that loan, which is set in the legislation, and that is the equivalent of repo plus 1. So I don't know what the repo rate is now, plus 1%. That is the calculation method you use. So if you've got a loan of R1 million, then obviously you must deem an interest of repo plus 1 on that. And that actual interest portion that you don't pay, or the trustees don't pay you, that is a donation. And that will be subject to donations tax. So all they're doing is they catching your estate duty planning mechanism by taxing you in advance for estate duty by triggering that as a donation. So Section 7C is basically just trying to get around this whole mechanism where you peg your estate by making a loan to a trust, and they basically just imposing an estate duty in advance. That interest component will be deemed to be a donation. And I think the question last time was also, what's the issue with offshore trusts? Well, that's a very more debatable issue, because in my view, Section 7C doesn't apply. There's a different section that applies, Section 31, which is transfer pricing. And if transfer pricing provisions apply, Section 7C doesn't apply. But be it as it may, if there's a foreign loan that is subject to Section 7C, the interest component is the repo equivalent in that base currency, or the jurisdiction of dollars, that will be the dollar repo equivalent plus 1 basis point. So it's the same thing, just on a different repo basis that you calculate that way. As far as probate is concerned, this is typically, and I'll always use this when I do presentations, to say if you get on the airplane and you go to Paris, and you get on the airport and you arrive at the Avis, rent a car, and you dish out your local driver's license, they're not going to give you a car. They're going to say, where's your international driver's license? So a South African executor who is appointed in terms of a worldwide estate only has jurisdiction in terms of South African assets. In order for that executor to get verified or authorized in that different jurisdictions where the assets are situated, it can be multiple, you can have multiple probates depending on where the assets are. Each country will have its own probate requirements. You must actually go and prove your status as an executor in that jurisdiction. And that is basically then the probate that you get, and that is what we call a grant of probate. In other words, you get an equivalent of a letters of executorship in that jurisdiction as you would have in South Africa. So a probate is basically the executor's international driver's license. That is the verifying that he is actually capable and in terms of South African legislation authorized and the will is valid and all those type of things. That's the probate process. So a South African executor can't just pitch offshore and say, here I am, I'm the executor, you guys listen to me. They say, no, you have to go through our process so we can verify that you are actually who you say you are and you are duly appointed. So that is in a nutshell the probate process offshore. Sorry, I forgot the other one.
Last one was
the other issue. Situs issues, yeah. Situs is typically, if you're a Latin fan, it means basically a place where something is situated. So in the tax world, if you have an asset, every country has got their own rules. So let's, for example, say you've got a property. A property is in Portugal. It's built in the soil of Portugal. So therefore, the situs of that property is in Portugal. That is a Portugal situs asset. When it comes to movable assets, it becomes a little more tricky. So when it comes to shares, cash, all those type of things, most countries, particularly in this case, and we'll deal with that a little bit later, you have different rules in different jurisdictions which determine which asset has a situs. And yeah, we're talking basically for inheritance tax purposes. So in the UK, if you have a share in the UK and the share register is kept and maintained, then that share qualifies as a UK situs asset. In the US, they spell color COLOR for a reason because they just shorten everything. There they just say if you have a share on the NASDAQ or listed, is that company a US company, yes or no? If it is, then it's a US share. Cash and all those type of things are a little bit different. So you have to go and analyze each share or each asset that you have to identify whether that will qualify as a situs asset for inheritance tax purposes in that particular country. And there's quite a misperception that if you hold assets through a nominee company, and the Swiss are they love to say, well, because we hold the title in this asset, it's through our nominee company, so it's outside. For tax, it's a different issue. You have to go and look at who the beneficial owner of those assets are. So if you're in South Africa and you hold a US share through a Swiss brokerage where they have their nominee company, you are still owning that US asset, whether it's through a nominee company or not, it doesn't make a difference. So the situs is really for inheritance tax purposes where that asset is situated. In other words, for that jurisdiction to enable you to tax the person on death if that asset is situated in their jurisdiction.
Okay. Thanks for that. That's I think you've actually answered one of the questions we had last time as well around this nominee structure, because that does create some confusion for people. So
I'll call a spade, because the guys say, typically some of these jurisdictions say, we don't tell if you don't tell. So that's not, in my opinion, a good piece of advice.
Yeah, and that's going to land clients in trouble in any case. So it's something we'll avoid. So look, the topic we're going to get into is a very complex one. So what we've decided for the benefit of everyone watching tonight is to put a case study together, because I think it's probably the best way to go through a structured conversation. And what we've tried to do is actually look at what is something that we face with our clients on a daily basis. So we actually went and looked at quite a lot of our client scenarios and what's the most topical thing that we're dealing with in our client base at the moment. And I'm going to just run through, Anton, what we've discussed and set the scene here, and then we can start unpacking all the issues that we typically face in a scenario like this. So I'm just going to pop across, on the slide that we've put together. So what you'll see is there's immediately on the slide, there'll be a couple of jurisdictions. So there'll be a focus on South Africa. We're going to look at jurisdictions offshore like Australia, US, UK, and Mauritius, because those are typically very topical jurisdictions where people either have assets or children migrate to. So what we're going to focus on firstly is husband and wife that's married with the antenuptial. So they had some tax advice early on in their career, or some financial advice early on in their career. They've got 4 children, basically adult children at this stage. So first child remained in South Africa. The other children immigrated, and I think many people on the webinar tonight can identify with this, where one child sitting in Australia, there's one child sitting in the US and one in the UK. Each one of these have children of their own in those jurisdictions, so we'll touch on to the educational part of that in a second. But as I said, they received some financial advice early on in their careers where they set up a local trust, so South African trust, managed to get some assets in there at very low base costs, and they've got a range of assets in there. So as you can see on the screen, there'll be, maybe just to explain what we've got here, there's some shares in South Africa, so listed shares on the JSE stock exchange here. There's some properties that they hold in that local trust. And then the local trust via asset swap went and invested in some shares in the US and some shares in the UK. Then basically, over the period of time, the husband and wife took interest-free loans out of that trust, and they went and invested in a range of assets. So they basically went in their personal capacities, invested in shares also in US, UK, and then as a plan B, as what a lot of people, and we're seeing a lot of these adverts continuously on media and on TV at the moment for a plan B, some good things, some bad things around visas. So they managed to go buy property in Mauritius for a visa. So that's something that I think a lot of people can, again, identify with. Now, a key thing that they want to do is to basically, some of their children have, as I said, they've got grandchildren in some of these jurisdictions, and they're looking at making distributions to help with educational funding in those jurisdictions out of the local trust. And then also, in order to minimize local estate duty, the spouses decided, and I know there's a lot of information here, so we're going to get into unpacking all of these in a bit more detail. But they decided to leave the assets in their personal name to each other on the dying of the first spouse, and in case of simultaneous death to the trust. So we can unpack that in a second and what that means. And something that we've seen often with our clients is they've only got a local will dealing with their worldwide assets. And often those wills are written, they're old wills and they're written in Afrikaans, so there's some other complexities that come into that one. And then also, so I think we could probably park it there because we don't get into too much detail. I think we already said a lot. But Anton, these are things you see on a daily basis. Where do you want to start unpacking this? And where's your starting point with the client when you see a scenario like this?
I normally say to the client, there's an old saying in tax, you pay to Caesar what is due to him, not necessarily what he asks. But in most of these cases, unfortunately, there's not just one Caesar. There's a bucket load full of them here. And so to try and pacify all of them, and even, the saying goes, you only pay what is due to me, what they ask. In this case, what is due to him can be quite significant, and we'll unpack it. In the US scenario situation, the poor US beneficiary child will get nothing. The US may take the whole lot. So I think if we start with that, and this is really just today again, yesterday, I had a similar client, obviously not always with all US or UK, but in most cases, you either have a child typically in the UK or one of those jurisdictions. And that's quite problematic. I think if we just start from the top, it is really, and that's, historically, I see so many of these structures that have been done meticulously. It's excellent planning, because from a South African perspective, you can't fault these structures. It's outside the scope of estate duty because the assets have been placed into the trust. The growth is taken into the hands, placed in the hands of the trust. There's actually no South African estate duty liability on that, and obviously great mechanism for legacy planning, flow to the assets if the children remain in South Africa. And that's the main thing. So I always say to people or clients, if the child has got an inkling of leaving or going, even if they go studying, and review your structures, and we can have a look at this just as it stands at the moment. But let's just start with the easy part. So obviously, because the trust, because the settler and the spouse has made use of the trust, obviously they had some further good advice. They actually didn't take distributions from the trust. They took interest-free loans, and those loans are not subject. So loans that come out of the trust to a beneficiary is not subject to Section 7C. So that's fine. You can still make interest-free loans. And because that loan is a debt, so on your death, that debt will qualify as a deduction for estate duty. So that was very good advice. Now they've used their foreign investment allowances and they've taken that money offshore and they've invested in equity. And here's where the other Caesars come into play. So because it's now personal assets, it's assets in their name. And what you will see, particularly, because that loan in South Africa is normally in rands, your investments offshore is in foreign currency. So you've got a currency growth on that. It's not subject to estate duty, the capital gains tax, the currency growth. But the actual offshore investment growth for estate duty, if you bring that back into rands, there's a rand effect and an actual growth effect. So on death of the husband and wife, on their foreign assets, from a South African perspective, the difference between the value of the original loan and the actual value of the foreign assets in rand terms, measured at time of death, will still be an asset. So the difference will still be subject to South African estate duty. That's the easy part. Now, I think when we discuss, most of the clients we see high net worth individuals, so the equity holding in the UK is probably in excess of $1 million, and the same in the US. Now, if you die and you have got CITES assets, and for example, any UK listed equity will 99.9% of the cases be a UK CITES asset, and on your death, the UK will want their pound of flesh. They say, thank you very much, because you have assets in our jurisdiction. If you die, you are still liable to inheritance tax in accordance to our rules. And in the UK, the inheritance tax rate, wait for it, is 40%, not 20 or 25% like in South Africa, above the null rate band, which is £325,000. So that is your effective estate duty liability in the UK. If you have more than 325,000 UK CITES assets, and those shares will qualify as UK CITES assets. In the US, it's exactly the same. Luckily, they've got a sliding scale, but their top rate also kicks in at $1 million, and then the rate is also 40%. Now, in the UK, because I think the rule here says that it goes to the spouse, so on the first dying spouse, there won't be any inheritance tax payable in the UK, because the same provisions apply in the UK as applies in South Africa. So in other words, you've got rollover relief. But on the second dying spouse, will pay tax or inheritance tax on that. But same in South Africa, because of the null rate band. So in South Africa, 3.5 million you accumulate to the second spouse. So in the UK, if the second dying spouse dies, then the asset component for tax purposes will be the value of the asset less £650,000, because it's £325,000 plus 2. So UK not so draconian, but you're potentially going to have a 40% estate duty element in the UK. And the UK says, we're not worried about South Africa. That's not our problem. You have assets in the UK. Thank you very much. You pay tax here. The US, much more draconian. In the US, you don't have rollover relief, even if you are married and you leave all your assets to a spouse. The only exemption you get is $60,000. A meager $60,000, that's it. So even if you leave it to your spouse, you are going to pay on your portion of the assets that you leave to your spouse up to 40%, or 40% if it's $1 million and more in the US. There's no question asked, it gets paid in the US.
Anton, can I just ask on that basis, is there a double tax treaty? Is there some offset in South Africa
correct.
against that?
And there's also a misperception that, because we've got a double taxation treaty, you don't have to worry about that. That's not the case. All the double taxation treaty does, and luckily we do have a double taxation treaty in the UK and the US, one of the 3 or 4 we have, and that basically says in a nutshell that you will get relief from the South African estate duty. So in other words, you're not getting relief from the US or the UK estate duty. You will not end up paying South African estate duty on those assets. So if it wasn't for the double taxation treaty, you would effectively have paid the 40% there plus the 20% here. So all the double taxation treaty does is relieve you from the South African estate duty. And it's a calculation method. It's limited to the amount of South African estate duty you actually paid, or would have paid in South Africa. So you can't actually get the 40%. You can only get the 20% in South Africa, because you can't get more. The tax credit in South Africa is never more than the amount of tax you would have paid in South Africa. So in a nutshell, all the double taxation treaty does is it actually eliminates double taxation. So if you didn't have the double taxation treaty, you would have actually paid 60%. So that's the consequences of having those type of, and these things can be easily avoided. There's lots of solutions to get around that. Having that in a foreign company, your tax situation is going to be the same. Having that in a roll-up fund or a unit trust fund, or using these wrapper vehicles, all those type of things will easily take you out of those. And I refer to those type of taxes typically as unnecessary taxes. There's no real reason why you have to pay that. By making a little bit simple structures, there's quite a lot of solutions to go that far. So that will be the first problem that they have if they haven't actually held their assets in suitable investment structures.
Yeah, so just getting back, the first solution, we actually need to look at those shares held directly in their own name and find an alternative, either, as you say, holding it via wrapper, or we also got questions. I mean, there's the first couple coming through here. If you had to use or hold those via a collective investment scheme or an ETF, maybe just touch on those as problems and solutions as well.
Collective investment scheme is a powerful tool. So typically, Irish collective investment, anything outside the UK or the US. So if you have a collective investment scheme in Jersey, Guernsey, Ireland, one of those jurisdictions, they don't have those type of taxes. Ireland does have a tax called capital acquisition tax, but it doesn't apply to non-residents. So you are outside the scope if you have suitable collective investment schemes. The UK even goes a little bit further, and I don't want to go into too much detail, but you can actually have certain qualified UK collective investment schemes, and there's basically authorized unit trust funds or open-ended, OICs as we call it, open-ended investment companies. Those are exempt from UK inheritance tax if the beneficial owner is not domiciled in the UK, and that's the criteria there. But that's why it's so important to get advice on these type of things, because the people, I see it so often, get it totally wrong. But yes, collective investment schemes in a suitable jurisdiction gets you out of these type of things quite easily.
Okay, so if we move on to this property they've got in their own name in Mauritius, maybe just touch a bit on that and what you see is going on there.
When I see this, and what I say, with Mauritius applies to Portugal, most of your European countries, we see this all the time. So most people, plan B, buy a property, invest, you get your visa, your permanent residency, and all those type of things, nice things. Now, this is probably not a tax angle, but this has an effect on the tax angle, because husband and wife, if they die first, the assets go to each other, and that will basically, from a pure South African perspective, giving out the offshore side, will not have any estate duty consequences. However, Mauritius is what we call a forced heirship jurisdiction. Same as most of the European countries. If you go east of the UK, all those countries have got civil law or Napoleonic code, or it's basically you can't disinherit your children. That is what forced heirship means. Everybody's heard that phrase. So if you die and you nominated your spouse, in some instances it may work, but in Mauritius it doesn't, the spouse actually cannot benefit in title. So the spouse may at least get at best a usufruct or a right of use on that property. But if you have 4 children, those 4 children become the actual heirs of that property. You can't disinherit them. There's a small portion we call the free portion. It's about 25% of the estate you can freely give. But under Mauritius, even if your will says in South African law it goes to your spouse, and the property is again a Mauritius situs property because it's subject to Mauritius laws, the Mauritius laws dictate that it will go in a certain succession fashion, and it best in the hands of the children. You can in your will say until you're blue in the face it goes to X, Y, Z. It won't happen. It will go to the children. Now that will have an effect on your estate duty planning, because if that property is worth, let's say, $1 million or whatever, that $1 million is now going to be subject to estate duty because it's not going to the spouse. So now all of a sudden, you have an estate duty liability which you didn't account for. And secondly, the asset is not ending up in the hands of the persons you wanted it to end up. So it's quite important to get advice when you're looking with buying physical property with some of these residency schemes, because what people think will happen is not necessarily what will happen. So typically putting that in a company or a structure or something will make it worthwhile from that aspect, but that has secondary effects again, because if you put it in a company, it may be subject to Mauritius tax because there may be deemed income on that. So it's a whole issue. It's not as simple as it sounds when it comes to the Mauritius property. So just make sure that that people understand that, you know, under forced heirship regimes, your effect in the will can be invalid.
Yeah, I think the problem with a lot of these property schemes is you have to invest in your own name to qualify. So it does create a planning issue there.
Not necessarily. There's quite a few of those where they do allow for you to actually hold it through a structure because they actually look at the beneficial ownership as well. So in Mauritius, you can, for example, buy it through a structure. I think most of the estate agents just don't want to do it. It's easier. It's an easier sale.
No, I can't comment on that one. I see I've got an interesting question here, which I don't know if you've got the answer to this one, but just around this forced heirship, where they ask around the Hague Convention around these things. Is there something you can share on that?
Yeah. Forced heirship, Hague Convention is, you know, there's so many different Hague Convention issues that apply, and people confuse, I see it quite often, the Hague Convention with Brussels 4 or the EU regulation. Most of the European countries are not really party to the Hague Convention that determines how assets will be devolved and which rule apply and all those type of things. Very few actually subscribe to that. And I think, as a matter of fact, I think that portion of the Hague Convention is not even ratified or in effect yet. What has happened since 2012, there's an EU regulation, and we commonly refer to that as Brussels 4. And that basically says, if you have a property in one of those jurisdictions, you can elect as the testator that your law of your nationality applies. Now, there's been a lot of rigmarole, and some countries opt in and other countries opt out, but it's more or less finalized now. So, yes, indeed, you can have, if you specify in your will that if you have assets in the EU or EU member countries, that the Brussels 4 provisions or the EU regulation apply. And then I'm actually sitting with one as we speak at the moment to try and basically get that through, that you actually apply the laws of South Africa, which is freedom of gestation and not forced heirship. This is still very new, so expect some bumps in the road, but yes, legally, that is 100% correct. You can, in terms of the Brussels 4 provisions, elect the South African succession laws to apply, i.e. your nationality.
Okay, Anton, maybe let's get to the next part, which is probably going to be a very complicated one, and it's around the distributions of this local trust to these children in the different jurisdictions. So, you know, there's different distributions here. So there were distributions just, you know, over time out of this local trust from income and capital over time, but also now there's a need for some of these children, or the parents feel that they want to support the grandchildren essentially with education overseas. Because there's substantial assets here and they want to contribute towards that. So maybe just talk us through some of the issues with that.
Yeah, just before we get to that, I think I forgot, we can just add, I see that in that trust, there's also an asset swap. Now, you have to be careful because there's another Caesar, and that's HMRC. So if a local South African trust holds assets via an asset swap, and those shares are also UK shares, in the UK, there's a special rule we refer to as the 10-year charge. And basically what that means, if a discretionary trust, and it doesn't matter where it's created or where it's under which country it is a discretionary trust, if that trust holds shares in the UK and the value of those shares are more than £325,000, every 10 years, the trustees must go and revalue those assets, and there can be a charge up to 6% on the value of those assets. And that's a 10-year charge. So in certain instances where people have asset swaps, and depending on the mechanism of that asset swap, the South African trust can be subject to that 10-year charge. And there's a lot of trustees that don't actually know this. And this is a trustee responsibility, not the beneficiaries. It's a direct trustee responsibility. And that adds on to the trust complexities. So let's start with the worst case scenario. So if you have a beneficiary who's in the US and that person is qualified as a US person or a US resident for tax purposes, which can basically be, if you've got a US passport, you automatically qualify as a US tax resident or person. If you've got a green card, you automatically, the Americans just say, if you've got the right to enter the holy gates and enter into the US, we will tax you wherever you are. Doesn't matter. You are a US taxpayer. And even if you spend long enough time in the US, you can also become a tax resident. So if a beneficiary is in the US cannot tax you as a beneficiary if you have not had any distributions. And this includes, if I talk local trust here, we can probably look at an offshore trust, same principles apply. What the US does, and they apply what we call throwback rules. They say we can't tax you during the period that you haven't had a benefit. But if you get a benefit, and as soon as you get a benefit, i.e. a distribution, we will then back tax you from the moment that you were, one, a beneficiary in the trust, and two, also a tax resident in the US. From that moment, we will assume that you had the right to income or capital gains in that trust, and whatever undistributed net income was in the trust for that period, we will tax you in reverse. So the effect of that is, if you make a distribution now, you will actually be taxed on the value of that distribution. It's quite a complex calculation for the period that you have been a resident and you've also been a beneficiary in that trust. And if you do the calculation, the tax is normally not that bad. It is the actual penalties and interest. And if you look at it roughly, after a 6-year period, after you've been resident, you've also been a beneficiary in the trust, and the trust makes a distribution, and the trust consists of undistributed net income. In other words, there's income or gains accrued in the trust, then the IRS will take that whole distribution. You will not see a penny of that. And the IRS said, no, there's at least a silver lining, because the calculation can be more than the actual value of the distribution, but we will only take whatever you get. So that's the worst case scenario with the US. You have to be very careful. And I see it quite often. The accountants in South Africa typically make distributions to beneficiaries because of a conduit principle. If you're a US beneficiary and you receive the benefit, you trigger a tax liability immediately. And it's almost impossible to rectify that. In the UK, which is the second worst, they basically have got all these complex rules. If you are a resident in the UK, depending, there's non-dom status and rising basis status, all these type of things. But broadly, it doesn't matter. If you qualify as a non-dom and a remittance basis user, typically most beneficiaries want to utilize the funds they get from the trust in the UK, either to buy a property or for education purposes, and all those type of things. As soon as you bring that money onshore, the HMRC will ask the question, thank you very much, where did you get this money? No, it was a distribution from a trust or a benefit. The distribution actually that goes wider than just the distribution. It basically goes to a benefit that you receive from the trust. Then they will ask, what is the nature of this benefit? Was it the income benefit or was it the capital gain benefit? And if you say income, then they want to say, well, we want to see that that's income, because in the UK scenario, it becomes extremely complex. In essence, what a South African trust has to do to comply with the UK rules, when the original trust capital goes into the trust, you need to keep that in a separate pot, in a separate bank account, actually. Any growth or income subsequent to that, you have to segregate. You can't put it in the same account, because if you do it and you put it in the same account, it falls foul of what we call the mixed fund rules. Because it's like salt and water. Once you've mixed capital income and capital gains, you can't unmix it anymore. And that becomes the problem, because if you make a distribution and you say it's from income, then they want to say, well, doesn't it contain capital gain? And most likely in South African situation, because it's been so commingled, you can't show that. And they will then basically tax you under the punitive provisions, and that liability will then typically be 48% on that distribution, unless you can actually show all these things, which is virtually impossible. We've tried that. There's motor defenses you can use, but they don't actually fall for that. They just tax you at the highest punitive rate. Australia, up to 2 years ago, you could actually also distinguish between capital and income and all in the corpus. Australia just now says any capital or any income in the trust that has accrued since the original amount went into the trust, we will tax that as income. We don't, and this is typically when Dennis Davis did his reporting a while ago when he wanted to tax all income from foreign trust. He's not clever that he sits and thinks these things out. He looks at what the other countries do, and that's basically what Australia did. They basically tax all distributions from a foreign trust as income, 45% flat. Thank you very much. And that's not all. It actually goes further, because in the South African context, because most of these beneficiaries have typically ceased to be South African tax residents because they don't want to be subject to this new expat tax and all these type of things. So you cannot conduit any capital gains out to a non-resident beneficiary. So the trust will actually pay the full capital gains. You can't distribute that capital gain out. So now you can go do the calculation. In the US, they will take 100% of what you receive. And in South Africa, the trust will pay 36%. In the UK, they will typically take 48%, plus the trust will pay for 36%. And I'm generalizing here with capital gains and all these type of things. But those are the worst case scenario. And the same with Australia. So your effective tax rate, if you don't get this right, can be 45% in Australia and 36% in South Africa in the hands of the trust. And it gets worse because there's two different entities being taxed. In this case, South Africa taxes the trust. In Australia, the US, and the UK, the beneficiary is taxed. There's no double taxation treaty really, because the same person doesn't actually pay the tax on the income twice. So it becomes hugely problematic when you have a South Africa, and I say a foreign trust applies exactly the same principle. When you make distributions out of these trusts, if the trust have not actually been managed from day one in accordance with those rules. So this poor client who's done meticulous planning, he's been having the best trustees, everything 100%. This whole structure is extremely punitive for, especially if something happened to them tomorrow and both husband and wife died, especially because the will says everything goes to the trust, you would have huge problems. Essentially, the South African beneficiary will probably be the only one that will end up benefiting, because if you give anything to the others, those Caesars will just sit with a big smile on their face.
So, I mean, I know we don't want to give all the solutions away, and that's part of the reason why we keep saying people need to come for advice and speak to someone like yourself and you know some of the other people in our business to get guidance on this. But there are obvious solutions to these things. I mean, and that's why you know this is something that, and why you continuously have to speak to your clients about this and understand as circumstances change. You know, with kids going overseas, one needs to look at how do you restructure these things in order to avoid all these punitive charges down the line. So maybe just give some, if you can give some high-level guidance without necessarily giving away.
And that's why I say the most important and the simplest is, if a child has the inkling of going, even if it's for study purposes, time is your friend, because whilst they are not resident in those jurisdictions, we can sanitize these structures quite effectively, and we can manage it, either form a new trust or create a different mechanism or distribute some of the income out. In the worst case scenario, what we've done is basically where, you know, it was too far gone, the kids have been there, they're resident. We have actually, just as a simple solution, terminated the whole trust structure, paid all the assets back to father and mother, distributed out to them equally, and in their wills, they left all the assets to these children. And it's much cheaper to pay the estate duty in South Africa, which is 20%, than for the IRS or HMRC or the Australian Tax Office to take the whole lot. So there are simple solutions. There's more complex solutions. It depends on the appetite of what a client wants to do. Sanitizing the trust before or managing the trust correctly in anticipation of this is probably the most or the best solution, really.
So maybe, Anton, because that
default is to terminate the stuff.
Well, one of the questions that's come through here from a client that's been living in the US for quite some time and has given up the tax status here, they were wondering, so if you had to think about a similar scenario to this, but except that the distribution's coming from the parent directly, so what would be the difference in that scenario versus what this trust is?
So the UK and the IRS, they're not stupid. They've already looked at what we call intermediary rules. So if you, and we used to do this, to give you an example, 5-6 years ago, it was quite common to form a South African company, for example. The South African company was then owned by the foreigners. They were the shareholders because they were typically immigrants. It was and there's no exchange control for non-residents. So we made the beneficiary of the trust the company. So the company distributed the assets, the trust distributed the assets to the local company, and the kids took it out as dividends. Yes, they paid a little bit of dividend withholding tax and all these type of things, but fine, you got to run that. They stopped that. If you now make a distribution to a relative or a third party, they see that as that distribution going to the individual directly. They refer to those as intermediary rules. You can't actually do that anymore.
But if you had it in your personal capacity, so let's just say in my own personal situation, I own a couple of assets in maybe South Africa and other places, and on my demise, that gets distributed to a child that's living in the US.
Zero tax.
Okay.
There's no tax. Yeah. That's why I say on death, both in the UK, Australia, and the US, if you receive something as a pure inheritance, it's only South African estate duty payable. Nothing else. There's no taxes on you receiving a inheritance.
And then another question here. So going back to that interest-free loan from the trust to the natural person, and you mentioned that it'll be a debt in your estate. Now the question here is, does this debt need to be repaid to the trust at death, or can it be written off at death?
Now, what we typically do is, as a standard clause in most of the worlds, we just basically say any liabilities due or any loans due by a foreign trust or by a local trust, we bequeath back to that. In the old days, those bequests used to be subject to capital gains tax. They've changed that. It's no longer subject to capital gains tax as long as there's donations tax or estate duty payable on that. So we basically just cancel those loans by bequeathing it. However, in this case, the trust has actually made a loan to the beneficiary. So that debt is a debt. I can't just say I don't want the debt anymore. So that debt is always going to be in your estate as a liability. So typically, yes, in certain instances that we have problems here, especially if that local debt exceeds the value of the offshore assets. You have to bring back certain assets in South Africa to physically pay back that loan. If the executor or the ultimate beneficiaries basically forgive the loan, that will create a donations tax, capital gains tax issue within the hands of the estate, for example. So the short answer is, in that element of the loan, yes, there will typically always have to be a repayment of that loan.
Maybe just going back to a point you mentioned around ETFs, and I know ETFs, we've got to be careful here because one, you can have an ETF that's in a fund structure or ETF that's in a listed structure. So, but the question here is, what are the tax and estate consequences of owning an ETF through a Swiss brokerage? And I think it's probably a bit of a baited question, but you can maybe give us some views on that.
Yeah. Look, like we've been struggling with this since we looked at this starting 2013 when this issue became relevant. ETFs, I'm not going to say I have an answer on specific US ETFs. UK ETFs, we fine with. The people in the US, they don't want to say. So, nobody wants to actually opine on this or give an opinion. Even the IRS is silent. They just say we will deal with it. You have to approach us technical division, all these stuff. An ETF, and I think more relevant, you can just deal with the UK. The UK is fine. The UK, even if you have a LSE listed ETF, as long as the issuer, and there's always an issuer behind an ETF, as long as the issuer is not UK based, that even though it's listed on the US, the LSE, it will not qualify as a UK CITES asset. But default is go back to the ETF provider, let them confirm that, because it becomes because you have to analyze the prospectuses and all these type of things, see where is the real issue, what's the domicile of that issuer, etc., etc. Theoretically, UK listed ETFs where the issuer is not in the UK, that should fall outside the scope of UK inheritance tax. Now again, going back to the US, anything that is listed on the NASDAQ or on the New York Stock Exchange is typically a corporation. And as I said, in the US rules, they class anything that qualifies as a corporation as a US asset or CITES asset. Now, and that's where the conundrum arises with US ETFs. Is it a US corporation? Is it not a US corporation? My view, if I analyze it, it is typically going to be a US corporation because the definition is so wide. So I would say all ETFs that are listed in the US will, in my opinion, qualify as a US CITES asset, irrespective of where the issuer is situated, which is the case in the US. So the default advice, unfortunately, a long-winded story. I'm not going to give you a clear-cut answer, but with these, I think the industry must put more pressure on the ETF providers to provide this type of information, because the only way we're going to get clarity on this is the same with the ADRs. In the old days, American deposit receipts, they also, was it US CITES, was it not US CITES? Eventually, the IRS came out, and I think there was a pending court case or something, and they clarified that. They say ADRs are not US CITES. So until the IRS actually gives a clear-cut guidance on ETFs, the default advice, rather safe than sorry, is all US ETFs, in my opinion. If you ask the IRS, they're going to say it's US CITES.
Anton, I think just maybe the question, I think the trick there was through the Swiss brokerage, and I think that probably is back to your point earlier of that's just a nominee structure, so it's still looking at the underlying ETF.
It makes, maybe if I can just give a little bit, if you want a little bit more detailed explanation. Guys get confused with legal ownership versus ownership for purposes of tax or taxation purposes. A nominee structure or a custodian, absolutely, that holds the asset as the legal title holder. So if you go and look at the register will say this asset belongs to that nominee company. But that's all fine for legal purposes. We in tax, we operate in a different world. And the other OECD guidelines are very clear. In order to determine who the actual owner is, you have to go and look at who's the beneficial owner. That is the owner for tax purposes, not the legal owner. So if you qualify in terms of OECD models, what the OECD principles say, they say you as a beneficial owner need two requirements. You need to have control over the asset, and you need to have enjoyment over the asset. So if we turn back to the nominee company, a nominee company just sits there. It cannot have any liabilities. It actually holds that asset on behalf of somebody else. So if that somebody else tells the nominee company, give that asset to the man in the moon, they must do that. They've got full control, but they've not got enjoyment. They are at the behest of the person behind them. So they don't meet the OECD beneficial owner criteria. In other words, a nominee company doesn't have control and enjoyment. The person who sits behind the beneficial owner, because he can direct the nominee company, he's got control, and secondly, he holds it for his own benefit. So the beneficial owner is the person who you actually go and look at for CITES purposes. You can ignore the nominee company is transparent. It is a see-through. It means absolutely nothing in the world of determining whether a CITES is outside or not outside. It goes to the beneficial owner. If you as the client hold the asset through a brokerage, and that brokerage has got a nominee company, you have got the benefit, the enjoyment and control. Therefore, for IRS, US purposes, Australian purposes, look through. They don't care who the nominee is.
Anton, I see we've actually gone through our hour very quickly here, so we've come to the end. But I just want to maybe if everyone can grace us 1 or 2 more minutes here. We've received a lot of questions. If you can maybe just give us a short view on this, but there's quite a couple of questions around if you have your asset swap going into offshore assets, but it's typically either via living annuity in South Africa, obviously, or you putting it in an offshore wrapper. Maybe just because I think there are a lot of questions on that and what the tax implications are. So maybe just a quick answer on that one.
If the people want to indulge, if you want to go, because you have to understand the theory behind this to actually fully grasp it. You're looking at an annuity, which is basically a pension structure. So in other words, the principle is the trustee principle. So in other words, somebody holds something on behalf of you. And that structure wherein they hold it is a formal structure. And we can bring that down to a unit trust. This is why unit trust funds and all these type of things. Going back to the enjoyment and control function. In South African context, if you have a pension fund, they can dictate who the beneficiaries are, who they're paying to. They hold that asset. You are merely a beneficiary to expect a reward. So your enjoyment and control is actually within the pension fund structure or within the unit trust fund structure. So your legal ownership and your beneficial ownership sits with those structures. So in other words, those things do not die. So you only have sitters and all these type of things if there's a death event. So if you have life annuity in South Africa, that is actually held on the balance sheet of the insurance company. So you are only a beneficiary, or you've got an expectation to benefit from that in terms of the rules of this whole scheme. So therefore, that structure doesn't die. It holds the asset. Therefore, it's not subject to UK CITES, and that applies to unit trust funds and all those type of things. So you are free to invest in US and all those type of shares through an annuity structure or a policy structure or a unit trust fund structure. That's why those things are outside the scope of the US CITES criteria, because it holds the assets as the beneficial owner, not you. If you look at a policy structure, it's different. In a policy, you give assets to the insurance company. Those assets are on the balance sheet of the insurance company. If the insurance company goes bust, you lose your money. So it's their money. You have a right to claim from the insurance company depending on the policy contract, which typically is equivalent to the underlying assets that they hold in that structure. So there's a different structure in terms of ownership when it comes to these products. And that's the reason why they fall outside the scope of the US and UK CITES.
Perfect. Yeah, I think we've over our time here. So Anton, I just want to say thanks for that. I think it was extremely invaluable information there. And I just want to thank everyone for joining and dialing in tonight. We will be hosting our next webinar where I'll be speaking to Stanley Braun around global estate planning, and that'll be on the 27th of July. So please dial in for that again. This webinar will be made available on our website, and we'll email it to everyone that's registered for this. And there's a lot of questions we unfortunately didn't get to. We didn't have enough time to get all the questions, so we will give some written responses to those questions as well. And just lastly, from my side, I know we're in the midst of this next wave, and I think that there's a lot of anxiety. I think we're all feeling it. So hope you all stay safe, and especially whether it's from a health perspective or people going through tough times now with income in their businesses. We sincerely hope we're going to get through this quite quickly. And hopefully by the time we speak to you again in this next webinar series, we'll have some better news around where we are with this next wave in this pandemic. So from myself and the SPW crew, thanks for joining, and we'll speak to you again next month. See you.